I'm optimistic the CPI next week will be in some solid shape.
Let's hope that's the case as the market tries to digest the second largest bank failure in history. The VIX is spiking, the S&P is back below the bear market trend, bond yields are collapsing, signaling a flight to safety to US Treasuries, while the market starts to price in a greater chance of a 25 basis point hike versus a 50 basis point hike. Now, I thought there'd be more panic into the dollar, but it actually moved lower, suggesting the risk of hiking is greater than the risk of reflation from the strong employment numbers. The employment report came in hotter than expected for both non-farm payrolls and labor force participation, but the unemployment rate is finally ticking higher, and we saw jobless claims climb earlier in the week. Now, the bond market is smart, and the last time yields collapsed to this degree, the Fed reduced the rate hikes. Now, 25 will take us to a 5% Fed funds, but when you consider the rise in unemployment, jobless claims, and the first major collapse, is it possible that the Fed will pause and wait? But of course, this depends on the inflation report.
Inflation's been down for many weeks in a row now. I'm confident that we're headed in the right direction.
If Joe's confidence is a spoiler to the next inflation report and SVB turns to contagion, is a pause on the table.
But the other side of this is
yes,
how widespread
but they just closed the
it is.
bank with $200 billion in assets. Are we missing the plot here?
The failure of Silicon Valley Bank, the backbone of the tech industry, it has been shut down by regulators.
88% of Forbes' next billion-dollar startups, SVB clients. Half of all U.S. venture-backed tech and life sciences companies, they bank with SVB. 44% of U.S. VC-backed companies with an IPO in the last calendar year of 22, SVB.